Here's what no one tells you about stock research. You can spend hours digging through financial statements and still pick a loser unless you know the 10 critical steps I'm sharing in this video. And be sure to watch all the way to the end because most people skip number 7. Please don't be one of them. Hey, I'm Steve Reitmeister. I've been investing for over 40 years. So I spent more than a decade as the editor-in-chief of Zacks.com, and I'm currently a partner at WallStreetZen.com, where our quant team analyzes over 4,600 stocks every single day using 115 different data points. Today, I'm walking you through a tried and true process for analyzing any company, one that has been refined over many years of investing. Before we begin, hit that like button down below. That's because it really helps the channel out and it helps us create more content just like this one. Whether you're investing your first dollar or your millionth, these 10 steps will transform how you pick stocks and enjoy more investment success. Let's get started with step number 1. Get the basics down. Before analyzing your first company, you need a little financial literacy. No need to be an expert here, just the basics for now, starting with 3 financial statements. First, the income statement shows you how much money a company makes and spends. The balance sheet shows what they own and what they owe. And then finally, the cash flow statement shows where actual cash is coming from and going to. You also need to know a few key ratios. The PE ratio tells you how expensive the stock is relative to earnings. The debt-to-equity ratio shows how much debt they're carrying, whereas the current ratio tells you if they can cover short-term obligations. Are you going to have to learn more metrics? Yeah, but just focus on these ones for now, and you can build on that knowledge as you go along. Now it's time for step number 2. Understand what the business does. There's plenty of ways to go about this, but the easiest to go to sec.gov, search for your company, and pull up their most recent 10K annual report. Turn to item 1, which is the business description section. Depending on the company, it can run anywhere from a dozen pages to several dozen. From here, I do something called the 3-circle test, based upon 3 key questions. Can you explain it simply? That's circle number 1. Do multiple revenue streams overlap in a way that creates competitive advantages? And that's circle number 2. And be honest here. Are you generally interested in following this business for years? That's circle number 3. All 3 circles need to happen for me to move forward with the stock. Let's take Microsoft as an example. Their business description breaks out 3 clear segments. First is productivity and business processes. Second, intelligent cloud. And third, personal computing. They explain what products sit in each segment, what services they provide, and how they generate revenue. That's what you want to see. Now remember, folks, that's just step number 2. If there are any red flags in the beginning, you should move on to another stock. Don't understand the business, highly concentrated revenue, no competitive advantages, just skip that stock because there's no need to waste time on mediocre businesses. Stepping up to number 3, management discussion and analysis, also known as the MD&A section. So you like the business. Now it's time to take a look at management. Scroll to item 7 in the 10K, management discussion analysis. This tells you what happened this past year and what they see coming. One thing to keep in mind is that the 10K you're looking at could be relatively out of date, but the best thing to do here is to also check out the 10Q reports that are filed quarterly. Always pull up the most recent 10Q for the most current information. Now, I'm looking at a couple things here. Are margins trending higher? Is revenue growth accelerating or slowing? What's happening with debt? These documents are gold mines when it comes to that vital intel. You can really learn a lot here, what management is planning, what industry trends are at play, how each segment of a business is faring, and what the folks in charge of the company see as the top priorities. Quick timeout here. If you like this video so far, please go ahead and hit that subscribe button. That's because I upload weekly videos with stock picks and important investing topics like this. So subscribing to the channel is the best way to make sure you don't miss any of my future videos. All right, we are now moving on to step number 4, dive into the financial statements. Now it's time to look for the actual numbers. You always want to pull statements directly from the 10K or the 10Q filings, not some third-party aggregators. You're going to focus here on 3 statements. Yes, the same 3 we mentioned back in step number 1. The income statement shows revenue, expenses, and profit. The balance sheet shows what they own and what they owe at any point in time. And the cash flow statement shows where actual cash is coming from and going to. Here are the questions you're answering. What are their margins? What's the growth rate? Do they have free cash flow? How does free cash flow trend over time? Obviously, we want it getting healthier and healthier. For example, is cash flow growing faster than earnings or slowing? That tells you something about the quality of their profits. Now, the more you look at the actual statements, the better and quicker you can do in the future, such as recognizing patterns, spotting inconsistencies faster, and you understand what looks normal for different business types. Okay. Here's a down-to-earth tip for you. Batch steps 2, 3, and 4 together. Download the latest 10Q and the most recent 10Q reports. Any investor and presentation, shareholder letters, and earnings call transcripts all at once. They're interconnected. Okay. The 10K and 10Q are backward looking. They tell you what happened in the recent past. This is good background as we move into step number 5, which is forward looking. Okay. That is where we review company presentations and earnings calls. Some of the best stuff comes in the sections where Wall Street analysts ask questions, which shows you their areas of concern. If 3 analysts ask variations of the same question about pricing, pressure, or customer concentration, that's probably the biggest risk facing the business. Also check what metrics management highlights. For Netflix, that would be subscriber growth. For Amazon, it's what's going on with Prime and the AWS unit. For SaaS companies, where they're going to take a look at recurring revenue and customer acquisition costs. Track these metrics quarter after quarter. That's how you know how well management executes. Now it's time to value the company as we move on to step number 6. You still like the company. Now it's time to figure out what it's actually worth, okay? Try multiple valuation methods like discounted cash flow, PE multiple, enterprise value to EBITDA, price to sales for high growth companies, industry-specific metrics, and different methods for different businesses. The more experience you get, the better you'll be at choosing which of these valuation methods fits the company the best. Compare ratios with competitors, compare the company with itself from prior years, look for trends and changes. Then take a deep dive into management's plan. How long has their plan been in place? Are they actually executing it well? Can you see the results in the actual numbers? If analyst research is available, see what valuation methods analysts use and their estimates for revenue and earnings. Start with the consensus estimates as a baseline, then adjust based on your own thesis. Just don't adjust above the street height estimate, as that might be unfounded optimism. All right. Now let's really focus on step number 7, the critical step most investors are missing. We've calculated fair value. We know what we believe it should be worth. Now we need to know where it's actually trading. It's not about seeing the current price. Instead, pull up a chart looking back 6 to 12 months so you can identify the big spikes and big drops in the share price. What caused the drops? What made it go higher at certain points? Pull down the news from those time periods and identify the prime movers of the stock. But here again, let's take Microsoft for example. Every time there's news about Azure growth or AI developments, the stock moves dramatically. This tells you what Wall Street believes drives the stock. These are the catalysts investors actually care about. Why does this matter? You know what to watch for going forward. When similar headlines emerge, you'll know how the stock might react. This prevents panic selling. This reveals special buying opportunities. Most investors ignore this step. They research fundamentals but ignore the market psychology. When you know what moves the stock, you can act rationally when others panic. That's your big competitive advantage. Now stepping up to number 8. Look for buying opportunities. Here's what we know from the previous steps: what the company does, management plans, what we believe it should be trading at, and what moves the stock price. The next step is to determine what margin of safety you are comfortable with. Okay, let's use a hypothetical example. Imagine you are interested in a stock with a fair value of $50 and is currently trading at $47. Is that enough of a discount? Probably not. So you should take a pass on the stock for now, but do consider putting on your watch list, but potentially purchase if it drops to a more appealing price. Factors that influence your margin of safety would be things like the risk level of the company, meaning is it a stable blue chip or a volatile small cap? How concentrated or diversified is your portfolio right now across sectors and industries? Your confidence in earnings projections. The less confident, the bigger the margin of safety you're going to need to buy that stock. Also consider your time horizon. Can you wait 3 years or do you need results in the next 6 to 12 months? Okay. Here's where understanding price action from step number 7 becomes invaluable. Say a company reports revenue 3% below estimates due to temporary factors, and yet the stock sells off 15% in the news. You know from your research that nothing fundamentally has changed about the future. Okay, the business model is intact, their competitive position hasn't shifted, management is executing on their plan. This is a short-term overreaction with unchanged long-term fundamentals. This may be a great buying opportunity for those bold enough to take action. Now we move to step number 9, which is to build your watch list. Once you've completed your analysis, you need a system for trading opportunities. The easiest way is to build a watch list of stocks with the right fundamentals, but not exactly the right price. We have a great free watch list feature on WallStreetZen.com, so it helps you stay on top of the Wall Street analyst activity on your stocks, timely news, and any changes in our AI-driven quant model, the Zen ratings. Just scan the QR code to set up your free watch list now. Okay. You've analyzed the company, the fundamentals are solid, management is executing, the competitive position is strong, you've calculated your target price with the appropriate margin of safety, but it's trading at 90 and your buy price is closer to 80. Solution, add it to your watch list. Now it is wise to monitor for catalysts that could create buying opportunities like earnings reports, sector-wide sell-offs, or temporary negative news that doesn't really change the long-term investment forecast. Okay, when a catalyst hits and the price drops to your target, you already have the analysis complete. You can execute quickly while others are still scrambling to figure out what's happening. Like Warren Buffett loves to say, be greedy when others are fearful. Once you've added a stock to your watch list, move on to analyzing the next company. Don't obsess over watching one stock move day to day. There are always more opportunities to research and discover. Finally, we have step number 10, rinse and repeat. Build a research library. Keep notes on companies you've analyzed. Track your investment thesis by writing down why you liked or took a pass on a company. Review if you got it right or wrong, right? And be honest about that. Learn from every analysis and improve the process as you go forward, right? This creates a virtuous cycle. More research leads to better analysis. Better analysis leads to better investment choices. Better investment choices leads to better returns. Now let's consider the investment of your time, meaning that the first few companies will take hours to analyze properly, and that's to be expected. As you improve, the process gets faster. You'll start recognizing the pattern. You'll know which sections of the 10K matter the most for different types of businesses. Eventually, you can evaluate a company in 1 to 2 hours, maybe a touch less. But never rush the quality of your analysis for speed. A thorough analysis of 10 companies beats a rush look at 50. Get it? Right? Every company you research adds to your watch list. Now you've got 12 stocks, 15 stocks, 20 stocks that you deeply understand, just waiting for the right entry price. Maybe 1 hits your target this month. Maybe 3 hit next month. You're constantly building a pipeline of high quality opportunities. Okay. I've just walked you through a 10-step process that's, well, let's be honest, takes a serious time investment. Now I want to share with you a tip on how I compress this process and make it even easier. The result is less time spent and superior results. I'm talking about our in-house quant system, the Zen Ratings, which analyzes 4,600 stocks daily across 115 different factors. We're talking about growth, value, momentum, safety, financial strength, sentiment, and AI-driven signals. I use this as my first filter. Step number 1, I pull up the list of A-rated stocks. These are the top 5% that score highest across all these 115 different factors. That immediately narrows the 4,600 stocks reviewed by the system down to about 230. Okay, step number 2, I look at the component grades, meaning I'm more interested in growth, value, momentum, etc. Let's say value is the key for me. Then I need to narrow the search down even further by looking at just the A and B rated stocks for value. Now we have quickly gone from 4,600 stocks overall to 230 A-rated stocks, and then by focusing in on the best component grades, we get 20 to 30 prime picks worth a deep dive. Even better, the Zen Ratings is proven to find stocks that outperform, actually beating the S&P 500 by 3 to 1 since 2003. Not surprising when you analyze for stocks that scored the highest on this 115-factor review. Here's what the system does not do. It doesn't replace the research we just talked about. You still need to understand the business. You still need to read the MD&A section. You need to check what moves the stock price, right? What it does do is save you from wasting time on fundamentally weak companies. If a stock scores a C, D, or F in the Zen ratings, then I don't care how interesting the story sounds because the quantitative fundamentals aren't there. That's just a hard pass on that stock. Think of it this way. This 10-step process I just taught you is how you evaluate any individual company. The Zen rating system is how you decide which of those companies deserves that level of attention out of the thousands of stocks that exist in the universe. Okay. You can combine both approaches. Use the systematic screening to find the best candidates, then apply the research process to the ones that make the cut. That's how you invest with both speed and conviction. Want to see this in action? Well, I used our own system here to pick out 3 stocks most likely to double in 2026. If you're interested in checking them out, I put a link in the description, or you can simply scan the QR code to access the report. Most investors bounce from tip to tip, headline to headline. They chase the hype and fads and are utterly at the mercy of trends and recency bias. And unsurprisingly, that doesn't work out too well. Having a process like the one I outlined today builds real investing conviction and improves your results over time. Another bonus is that you won't panic when stocks drop because you will separate price action from the fundamentals and often appreciate that the price weakness is just a great buy the dip opportunity. You'll invest based upon fundamentals, not emotion. You'll get better with every company you analyze, and you'll learn lessons from the past that make you all the more successful in the future. Did I miss any steps you believe is best for analyzing companies? Well, please share your process in the comments below and let's compare. And if you want to learn more about investing, I recently did a video on the 8 rules that Warren Buffett himself stuck by as the foundation of his tremendous success. Check it out now.